welcome back to the deep dive. Look, if you've been anywhere near the crypto markets in the last, I don't know, few years, you've probably experienced it.
Oh, for sure.
That sudden spike of a coin you'd never even heard of.
Yeah.
And then, the inevitable crash.
Yep, often just hours later.
Exactly. Hours after some breathless, highly shared analysis told you it was like the next big thing. You're not just dealing with market volatility anymore. You're literally drowning in a flood of information.
Right.
And a lot of it, maybe most of it, is just fundamentally compromised. Every other day, there's a new expert telling you to buy this coin or short that exchange, and the noise is just, it's deafening.
It's more than noise. I'd say it's a constant, pretty sophisticated battle against hidden agendas.
That's a good way to put it.
The vast majority of financial reporting and analysis you see online, especially when it's about these emerging sort of unregulated assets, is just rife with conflicts of interest. Our source material for today is essentially a critical reader's fast check guide. It's a tool. It's designed to cut through all that financially motivated noise and, instantly filter out the garbage.
Exactly. So our mission today is to give you a genuine superpower. I really think of it that way. The ability to quickly filter fact from financially motivated fiction, which protects your time and, of course, your capital. We're not just reviewing this methodology today. We're going to try and internalize it to give you a proven framework you can use, like immediately.
And the document lays out a really clear, actionable methodology. It's based on 5 key signals to identify these conflicts of interest, or, COI.
Right.
The traditional approach is just blanket skepticism, which is frankly exhausting.
It is. You can't be suspicious of everything all the time.
You can't. So our goal is to move past that simple skepticism and give you practical techniques. If you can master this 5-signal framework and the checklist that comes with it, you will fundamentally change how you consume crypto news.
You go from being a passive recipient to
an active, critical evaluator.
Exactly. Okay, let's unpack this. I think we need to start where the manipulation so often begins, with the messenger.
Always.
Let's jump right into the first 2 signals. They focus squarely on the claimant and the evidence they're providing. This is like our essential first layer of defense.
Okay.
So we start with signal 1. Who wrote this and what is their background? The core question here is so simple, but it's, I think, revolutionary in this space. Before you even evaluate the claim, you have to rigorously evaluate the claimant.
No, absolutely.
What skin do they have in the game, and crucially, are they even showing it?
This is the most fundamental step. It's funny, in decentralized finance, we're all taught to, trust the code, not institutions.
Right. Code is law.
Code is law. But paradoxically, we then place this immense blind trust in the analysis that comes from key individuals on X or in some newsletter. The source material outlines 3 immediate checks you have to perform on the author, and you should treat these as, non-negotiable. They're prerequisites.
Okay, let's walk through those checks in detail. What's the first one?
First check. Does the author own a project or a company in the crypto space? It sounds obvious, but you'd be surprised how often it's overlooked.
Okay, that's pretty direct.
Second, do they benefit financially from the growth of a specific cryptocurrency? This could be, direct ownership, large staking positions, or even just getting paid to promote it.
And the third.
And third, do they have a public conflict with a known competitor? That last one is a massive, immediate red flag.
Especially in the exchange and protocol world, right? Where these competitive attacks are they're constant.
They're common. And that last check is so critical because it introduces a direct, powerful bias. If the author is trying to tear down a competitor, their primary motivation isn't truth.
It's competitive advantage.
Exactly. The source gives us these great real-world examples that illustrate the different categories of conflict. And the way they categorize them really helps it stick in your mind.
Let's get into those.
Let's start with the example of Martin Stránský. He's the CEO of bit.plus, which is a platform for trading cryptocurrencies.
Okay.
So when Stránský issues an optimistic Bitcoin forecast, the analysis correctly points out that this inherently drives up trading volume.
And fee generation for his platform, bit.plus.
Precisely. This is labeled in the source as a hidden COI, a hidden conflict of interest. And it's hidden because there was no disclosure made about this inherent, profit-driven interest in the article itself.
So he benefits directly from the action the reader takes.
But he stays silent about it.
Wow. A hidden COI is so insidious because you're sitting there thinking you're reading objective analysis, but what you're really reading is it's marketing.
It's marketing designed to drive traffic and volume to his platform.
But what's the real consequence of that for the reader?
The consequence is that the analyst is incentivized to prioritize sensationalism and optimism over, cautious, balanced reporting. If the forecast fails, sure, they might lose a little credibility. But if they don't publish an optimistic forecast, they lose transactional volume today.
And they're going to choose volume every time.
Every single time. This is where the methodology starts protecting you.
Yeah.
It forces you to recognize that a platform owner's forecast is never, ever neutral.
Okay, so now contrast that with the second type. We have Ben Zhou, the CEO of the Bybit exchange. Zhou publicly criticized Pi Network. The source labels this as an obvious COI. Why is that one obvious? And I guess the bigger question is that better than a hidden COI?
It's obvious because Bybit is a major exchange. So criticizing a potential rival or a token that they don't list, like Pi Network, serves to exclude that competition. It drives user engagement back toward their own platform.
Okay.
The key difference is transparency. Zhou publicly communicated his position. Everyone knows who he is and who he works for.
But wait a second. If he's public about his criticism, why is it still marked as a high risk or a conflict? Shouldn't full transparency be enough to, neutralize the threat?
That's an excellent and a very necessary challenge. Transparency is absolutely better than hiding.
Okay.
But it doesn't neutralize the conflict. It just identifies it for you.
So it's like a warning label.
It's a warning label. A transparent COI means you can apply a discount rate to the information you're getting. You can say, okay, I know the CEO of Pepsi hates Coke, so I'm reading this anti-Coke report knowing exactly where he stands.
Got it.
The threat is still high because the competitive pressure is intense. He's still incentivized to magnify the flaws and ignore the positives of his competitor, but at least you, the reader, are armed with that knowledge from the start.
Okay, so if hidden COI is basically stealth marketing, an obvious COI is more like open competitive warfare, what about the third type, the most dangerous one?
That would be the manipulative COI. This is exemplified by that anonymous X account pretending to be the Pi Tech team.
Right.
This account published specific lies. They falsely claimed Pi was about to be listed on Bybit, all in an effort to rally support and protect their own project.
So they're posing as a false authority to push propaganda.
That's a clear manipulation signal. It uses deception about your very identity to drive action.
And the power of anonymity in crypto makes this type of manipulation just incredibly scalable, doesn't it?
Oh, absolutely. When an account is anonymous or pseudonymous, the risk of a manipulative COI just skyrockets. You have zero accountability, zero of a track record, and zero consequences for lying. If that Pi Tech team account had been a known person, they would face massive reputation damage. Anonymity is often a prerequisite for a successful, widespread manipulation campaign.
So practically speaking, for you listening, this first signal really boils down to the crucial disclosure check.
Yes.
If an analyst is trading the asset they're promoting, or if their company profits from your trading volume, that interest must be transparently noted in the article. If that disclosure is absent, you have to assume a hidden COI is at play. And that's your first major warning sign.
Signal 2 then moves us away from the messenger's intentions and towards the strength of the message itself. The question is, are the claims supported by sources?
We have to stop taking assertions as facts.
And start demanding proof.
That sounds simple, but, in the rapid-fire world of crypto media, most people just read the headline and maybe the first 3 bullet points.
Right.
So when an article makes a really bold claim, what should we immediately be looking for when it comes to the sourcing?
You need to observe 3 fundamental things. First, does the article provide specific sources? I mean, named institutions, linked research papers, specific data repositories? Or is it just general claims like experts say or market data shows?
The dreaded experts say.
Exactly. Who are they? Second, are those sources tangible and verifiable? A link to a PDF on a university server is tangible. A source familiar with the matter is not.
Not all.
And third, is the author just throwing out data points without explaining their origin or their methodology? Data without lineage is mathematically useless and, frankly, highly suspicious.
The source material gives us this really useful 3-tier verification status. Using examples, it helps us grade the quality of the evidence.
Precisely. Let's look at that claim. Bitcoin will be 106 to 115K. If the author gives no source for that, the verification status is unverifiable.
It's basically a guess.
It was likely a fabricated forecast. It's a guess presented as a certainty. You have no external reality to check it against. It's just fiction dressed up as analysis.
Okay, then you have the claims that are partially verifiable, The example given is the claim that Pi Network is a Ponzi, which cited a 2023 Chinese police warning.
Right, so the warning itself is a real document. You can find it. But the source notes it's used without context.
Oh, yeah.
So the source exists, but the analysis might be cherry-picking the data or presenting it in a misleading way. It's a starting point for your research, not a conclusion.
And the gold standard is fully verifiable.
The gold standard. The claim that Bybit was hacked for $1.5 billion, cited CoinDesk and multiple other sources, and it was publicly confirmed by the exchange itself.
So the evidence is strong, cited specifically, and you can cross-check it against multiple independent reporting bodies.
That's the key.
So applying this methodology saves you time because you're not wasting energy digging through every single claim. What are the 3 steps you should immediately take when you see a specific data point or claim?
Step 1. The moment you encounter a specific claim, just stop and ask, how do we know that? Demand the lineage of the data.
I like that. Demand the lineage.
Step 2. If a source is cited, you have to try to find the original document or reference. Do not rely on the analyst's interpretation. Read the primary source yourself. And step 3, which is critical in mitigating COI risk, verify the information with at least 2 or 3 independent sources. A single source, even if it's named, can be flawed, biased.
But if 3 different non-affiliated financial news outlets report the same fundamental fact,
your confidence level rises dramatically.
and we have to emphasize the specific danger they warn about: outdated data. You might find a figure supporting some hyper-optimistic investment thesis like user adoption grew 500% year over year, only to discover that figure is 2 years old.
Right, it's from the previous bull run.
And that realization is a hard warning. Outdated or misleading number. The claim might have been technically true at one point in time, but its relevance now is basically nil, and its inclusion is deliberately misleading you into believing the current momentum is high.
It's a classic tactic, using true but totally irrelevant facts to build a false narrative.
That's a great transition because even if the source is up to date and the author is known, we still need to know, are they ever actually right? And that takes us to signal 3. Where we start measuring the author's actual performance against the cold, hard market. Signal 3 is, does it correlate with market reality? We're effectively grading the analyst's history here, moving from checking their intent to checking their pure competence.
This is what the source calls the analyst scorecard. In this business, past performance is relevant. You need to observe 3 criteria. First, do the claims align with actual market movements over the target period?
Okay.
Second, if they forecast X and the market did Y, what was the author's explanation afterward? Did they admit they were wrong, or did they just spin a new narrative?
A crucial point.
And finally, does the author have a consistent history of failure, a demonstrable lack of predictive success?
Let's go back to the example of Stránský's Bitcoin prognosis. He issued a very specific short-term forecast, 106,000 to 115,000 USD. The reality, as recorded in the source just 2 days later, was $101,800.
This is just a textbook example of poor accuracy. The price was almost 4%, 3.97% to be exact, below the boundary of his lowest prediction.
Wow.
Based on the source's methodology, the conclusion for that particular forecast is 0% accuracy.
You know, a 3.97% miss might sound minor to an everyday investor, but in crypto, especially if someone is trading with leverage based on that kind of short-term analysis, that 4% difference can lead to a catastrophic liquidation.
Oh, absolutely. It shows a complete failure to model short-term market dynamics accurately.
So if their accuracy is 0 for a short-term specific prediction, why on earth should you trust their long-term guidance?
You shouldn't. An analysis isn't just a snapshot in time, it's part of a historical record. If the analyst doesn't come back and address their failure, they are operating without accountability, which is another major COI flag, especially if they profited from the failed prediction anyway through volume.
Then we have the more complex example of Zhou and Pi Network. His prognosis was the very harsh label of Ponzi scheme.
Right.
The reality noted in the source is that Pi has been around for over 5 years without crashing.
And this is a great demonstration that the scorecard isn't just about price points, it's about the core premise. The accusation is severe. It's about systemic failure and collapse. Because the project has continued operating for 5 years, market reality has not yet validated the prediction of an imminent crash.
So what does the source flag that as?
It results in a theoretical concern flag, not a confirmed failure. The prediction might still be correct someday, but its immediate failure to materialize impacts the analyst's credibility score in the short term.
So we need to formalize this for you, the listener. The actionable advice here is to start building your own analyst scorecard.
Yes, it's essential, and it's actually pretty simple. First, write down the specific forecast and the date. You have to be specific. Ethereum will grow to $4,000 by year-end, 17.11.2025.
Okay.
Second, check back at the target date, say December 31st, 2025, and record the actual outcome. If Ethereum is at $2,800, you note that difference.
And third, you conclude on the accuracy, 0% accuracy.
Right. And the immediate consequence of a poor scorecard is that you have to mistrust future prognosis from that author. This establishes a meritocracy of performance. You don't owe them any loyalty if they consistently fail.
Okay, let's shift gears now to Signal 4. This one is more about intellectual character. We've checked their financial interests, we've checked their prediction success, now we check their commitment to intellectual honesty. Signal 4 is the author transparent and ready to debate?
This is the open mind test.
The open mind test. I like that.
This tests whether the author is actually committed to finding the truth and correcting errors, or if they're purely committed to promotion and defending their existing positions.
What should you be looking for?
You observe three things. Do they ignore criticism, or do they actively respond to it? Do they ever publicly admit they were wrong, which is a rare and very valuable trait?
Rare.
And do they block critics, or is the discussion environment open? A willingness to engage in debate indicates confidence in their analysis. Blocking critics indicates fear of scrutiny and, most likely, an agenda.
This is such a critical factor, especially in the toxic environment of social media where echo chambers just thrive. Let's see how our key players stacked up on the communication front. Stránský, the CEO of Bit.plus, he does not try to respond to criticism.
And that behavior earns him a clear, low transparency status. He ignores engagement. If you're a financial analyst, you are accountable for your forecasts. Silence when you're proven wrong is just an attempt to erase the record.
Okay. Zhou, on the other hand, debates publicly, but the source notes that he is emotional.
And this results in a medium transparency status. He communicates, which gives him points, but the emotional element suggests he might be arguing from a position of ego or competitive zeal rather than neutral analysis.
So it's better than silence.
It's much better than silence because at least the dialogue is happening, but it requires you, the reader, to filter for that emotional bias.
And what about the Pi Network team? They make statements, but they're described as unnecessarily silent on many issues.
That also falls into the low transparency category. It's flagged as being reactive instead of proactive.
What does that mean exactly?
They might issue a defensive statement after a crisis has fully developed, but they are not proactively addressing potential issues or engaging openly with legitimate user criticism. Low transparency suggests you are managing a narrative, not communicating freely.
I think we need a relatable example here. I remember early in my career, before I knew any of this, I was following an analyst who was constantly bullish on a certain meme coin.
Okay.
And I asked a very polite question in the comments about their circulating supply numbers because they seemed off. I was immediately blocked.
Wow.
I took it personally at the time. But using this framework, that was just a crystal clear signal.
That's the perfect anecdotal context. That reaction told you everything you needed to know about their agenda. They weren't looking for accuracy. They were looking for affirmation.
So how can you apply this criticism challenge today?
If you have a legitimate question or a challenge to their data, try reaching out. Use X, LinkedIn, email, whatever. Then you observe the response. If they reply, if they explain the complexity, or, and this is the best case, if they admit an error, that is the hallmark of a high credibility source.
And conversely?
Conversely, if they block you, ignore the question, or launch an ad hominem attack, that is a clear signal that the author is likely promoting an agenda and suppressing dissent. The way they handle contradiction is just as revealing as the data they publish.
Here's where it gets really interesting. We've assessed the claimant, the claims, their track record, and their transparency. Yeah. Now we get to the bottom line, the unavoidable truth signal 5. Who benefits financially from your decision? This signal forces us to look past the analysis and focus solely on the financial consequences of acting on it.
This is the ultimate risk check. You can just call it following the money. In the crypto space, the profit motive behind an analysis often entirely dictates its content and its tone.
So what are we looking for here? 3 things.
We look for 3 things. 1, if you follow the recommendation, who earns money? Immediately or systemically. 2, does the author have a direct financial stake in the outcome? And 3, and this is critical, is the author influential enough to run a pump and dump scheme based on their public statements?
That last point, the potential for pump and dump, is why this is such a high-stakes environment. You know, in traditional finance, market manipulation by large known figures is tracked and punished.
Right.
In the decentralized world, influence can be anonymous, it can be fast, and it can be devastating.
Exactly. And the source material analyzes our three key scenarios through this lens. The results are uniformly high risk.
Let's go through them.
First, Stránský and Bitcoin. The recommendation is to buy Bitcoin. Who benefits?
PiBazar, his platform, benefits through increased volume and trading fees.
Right. The risk is flagged as high because he, as CEO of a trading platform, can manipulate market sentiment just enough to increase platform activity. If he issues 5 optimistic forecasts a month, even if 4 of them fail, the overall trading volume benefits his bottom line.
Okay. Second, Zhou on Pi is a scam. The recommendation is not to buy Pi. Who benefits?
Bybit, the competitor exchange. The risk is again flagged as high. This is what the source calls competitive pricing. Eliminating or damaging a potential rival token or platform is directly beneficial to their own market share.
So it's zero sum. Pi's loss is Bybit's gain.
It's zero sum. And finally, the anonymous Pi account. Their recommendation is to support Pi based on a fabricated lie about a Bybit listing. Who benefits?
The Pi Foundation. They benefit through increased support, retention, user engagement, all of which is vital for the eventual launch of their ecosystem.
Exactly. The risk is also high because the foundation is benefiting directly from a lie used to elicit user action and support.
You know what's truly illuminating here is that all 3 scenarios, the hidden optimism, the open competition, and the anonymous lie, are all judged as high risk. Because the profit motive is so direct and so powerful, regardless of how transparent they were about their position, this just confirms that following the money is the non-negotiable final step. If the author benefits directly from your action, you must assume bias. Period.
This entire 5-signal methodology is powerful, but to make it truly actionable and fast, the source synthesizes it all into a comprehensive article review checklist.
This is the tool.
This is the tool that allows you to gain knowledge quickly and thoroughly before you make that high-stakes financial decision.
Let's present this full checklist now.
Yep.
We can break it down into its 4 major categories.
Yeah.
You should think of this as your internal mental firewall every single time you open a crypto news piece.
Okay, Category 1 focuses on author and motivation. These are checks relating to Signal 1 and 5. You ask, do I know the author's identity? Does the author have a financial interest in the topic?
Is this interest disclosed? That's the big one, the disclosure check.
Yes. And based on the context, is this article genuine opinion or is it strategic propaganda?
Okay, Category 2 is sources and facts. This is our robust verifiability check, which covers Signal 2. You ask, are claims backed by verifiable sources?
Are those sources explicitly linked or named? Can I verify the sources myself by clicking through or doing a quick search? And remember the warning. Is the data current and up to date, or are they using obsolete figures from 2 years ago?
Right. Category 3 addresses contextualization. This is where we check for balance. You need to ask yourself, are opposing views mentioned or referenced anywhere?
Are the inherent risks of the investment or the trend mentioned at all? Is the article balanced, or is it blatantly one-sided, offering only reasons to buy or only reasons to sell?
And the big one, am I missing any important contextual information that the author might have deliberately omitted to control the narrative?
And finally, Category 4 is reality. This connects right back to Signal 3, the scorecard. Ask yourself, does this analysis match what I see in the market right now, the actual price action and sentiment?
And was the author right in the past? If so, how accurate were they? How far off were their previous predictions?
Once you run through those checks, you score the article. And the source provides a clear, actionable reliability threshold. If you check 8 to 10 points, the article is deemed reliable. You can proceed with confidence.
Okay.
If you check 5 to 7 points, it's a caution, requires more resources. You can read it, but you need to seek independent confirmation before you act on it.
And then there's the danger zone.
The danger zone, if you check 0 to 4 points, it's a big warning, do not trust blindly. This is where you should immediately stop reading and just walk away from the financial recommendation.
We can't forget the source's perfect example of 100% manipulation using this checklist.
Right.
An article is titled XYZ Coin is the best investment for 2025. You run your checks. The author is the founder of XYZ Coin.
Strike 1.
The platform is XYZ's official channel.
The strike 2.
And the timing is right before a planned pump event.
Strike 3. That combination guarantees manipulation. The founder profits, the platform benefits from the propaganda, and the timing confirms the intent to inflate the price. That piece scores a solid 0 out of 10.
It's not analysis. It's a financial weapon aimed directly at your wallet. That checklist is just invaluable. Now that we have the full toolkit, let's put it to the test by revisiting our 2 primary case studies. This really illustrates the difference between pure deception and, say, biased competition. Let's start with case study 1, Stránský on Bitcoin.
When we applied the comprehensive checklist to the analysis from the CEO of Bit.plus, the score was a definitive 0 out of 10 checks.
0.
0. The conclusion is unambiguous. Low credibility. The absence of even a single checked box tells you this content was fundamentally designed for commercial, not informational purposes.
Let's just detail why this analysis failed every single test. On the author and motivation side,
The author is the CEO of Bit.plus. That means he has a huge financial interest in increased trading volume.
but there was explicitly no COI disclosure mentioned in the analysis. 2 immediate strikes right there.
Regarding sources, the analysis lacked any specific data links or verifiable citations. It was just an assertion of certainty.
And on the reality, check the scorecard.
The prognosis failed almost immediately. It missed the target boundary by nearly 4% within 48 hours. And finally, the communication test failed miserably, as the author did not attempt to defend or correct the statement after the market moved against his prediction.
A 0 out of 10 score, particularly in a public forecast that directly drives trading activity, just confirms that the article was fundamentally motivated by financial gain, without any pretense of disclosure, verifiable facts, or accountability.
It's pure hidden marketing masquerading as expertise.
Okay, now case study 2 is where the nuance really comes in. This is Zhou, CEO of Bybit, criticizing Pi Network. It's far more complex than the previous example. Before we look at the score, let's quickly establish context on Pi Network, because the sources spend a good amount of time on its background.
Right. So Pi Network was launched by Stanford University PhD students back in 2019. The goal was ambitious: achieve mass crypto adoption by lowering the barrier to entry for mining.
So they use a very simple and environmentally friendly method. Users just open the app and press a button once a day to mine the Pi coin on their smartphone.
And the genius of its growth structure is the network effect. Users can increase their mining speed by expanding their network. It's an incentive structure that fuels massive viral growth. The project also aims to increase the Pi coin's value by building a utility ecosystem where users can create and use web apps directly on the platform.
Crucially, the sources specifically note that after 30 mining sessions, users are required to pass KYC.
Yes, and this is important context. KYC traditionally stands for Know Your Customer in Financial Services.
Right.
However, the source material specifically used the term Know Your Credit when describing Pi's process. This emphasizes that users must enter their real names upon registration to avoid a 20% penalty on the tokens they've earned.
So while Know Your Customer is the standard industry term for identity verification,
The source's focus on credit or identity verification just highlights the requirement for true identity submission to unlock funds. For our purposes, the goal is the same: identity verification to prevent bots and fraud.
Okay, so we have a major competing platform CEO, Zhou, criticizing a mass adoption, identity-verified project, Pi. Let's apply the checklist to Zhou's analysis. The score comes out to 4 out of 10 checks,
Right.
which results in a conclusion of medium credibility, requiring careful reading and external verification.
This medium score is the lesson itself. The question is, why did he score so much higher than Stránský, despite also having a high-risk financial stake?
It has to come down to transparency.
It comes down entirely to transparency. On the author check, Zhou is the CEO of Bybit, so he has a clear competitive interest. But the source notes he is transparent. He publicly communicates his position, and his motives are widely known.
So the motivation is marked as a warning, but it's not an outright deceptive strike like the hidden one.
Exactly. He also performed better on the sources check because he cited verifiable information, specifically that Chinese police warning from 2023. You can actually go and verify that the document exists.
But the reality check is still a warning.
It is. His assertion that Pi is a Ponzi scheme is a serious theoretical concern that just hasn't been proven true yet, given that Pi has been around for 5+ years without crashing. But his transparency on the communication front, being verbal and debating publicly, gave him points. The key distinction is that he engaged.
The key takeaway here is just absolutely vital for anyone trying to get sophisticated about this. Transparency significantly raised Zhou's credibility score compared to Stránský's hidden COI. A transparent conflict of interest allows you to apply your own discount rate to the information. You know he's biased, so you read it carefully.
But a hidden conflict means you are being unknowingly manipulated by a 0 out of 10 analysis. Medium credibility means you read the article, but you understand the inherent competitive bias, and you only proceed after seeking confirmation from truly independent sources.
That's the entire point of this methodology, isn't it? Knowing the bias is the first essential step toward neutralizing its effect on your judgment.
That's it. That's the whole game.
This deep dive into decoding crypto conflicts of interest has given us a clear roadmap. We've explored the 5 signals. Who wrote it? Is it sourced? Does it match reality? Is the author transparent? And who financially benefits?
Right.
These signals, distilled into that comprehensive checklist, are truly the shortcut to being well-informed in all the crypto chaos. The real value of this knowledge, though, is in its immediate application.
Indeed. This methodology isn't just about vetting crypto analysis. It's an exercise in advanced media literacy that connects directly to behavioral finance.
Behavioral finance.
Behavioral finance is the academic field that studies how our psychological biases, things like herd mentality, anchoring bias, confirmation bias, cause us to make irrational economic decisions. Recognizing these conflict signals prevents the psychological manipulation that these authors exploit.
Give me an example. Like if an author fails the transparency test, signal 4, and blocks all the critics.
They are actively trying to reinforce your confirmation bias. They only want you to hear positive news about the coin you already hold.
And if you follow the analyst who scored 0 out of 10,
you are succumbing to an anchoring bias based on their unrealistically high price forecast. You're anchored to that number even though it was baseless.
Exactly. The framework we discussed today is your shield against those pitfalls. It keeps your decision-making rational and objective.
It does.
So as you head back out into the fast-moving world of crypto analysis, we want to leave you with a final provocative thought built on the dynamics we observed today.
Consider the fundamental difference in motivation. If the primary goal of some authors is pure volume like bit.plus, benefiting from increased trading, their content is designed to maximize activity. If the goal is competitive exclusion like Bybit attacking a rival, their content is designed to maximize their market share. How do those fundamental profit motivations change the way financial information is presented, even when some of the facts they cite are technically accurate?
The motivation warps the entire narrative.
It warps the narrative.
So apply the who benefits test to the very next piece of analysis you read online. If the author profits directly from your action, you have already answered the most important question, and you know exactly how much caution to employ.
Be critical, be curious, and keep applying the checklist.
We'll catch you on the next deep dive.